Hey everyone, we got some terrible news for ChargePoint stock investors. Unfortunately, the news has sent ChargePoint stock down 35% today on the day of the announcement. In this video, I'm going to cover that latest news out from ChargePoint. I'm going to answer what it could mean for ChargePoint stock investors. I'm also going to touch on if this is a buying opportunity for those looking at this situation and asking, is this maybe a good time to step in here and capitalize and buy ChargePoint stock? I'm going to answer that question too.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's jump into the news from ChargePoint, the news that has sent this stock price crashing today as a result of this announcement. So two separate things came out today. First, there was an abrupt change in leadership. The company announced a new CEO. Rick Wilmer will step in as president and chief executive officer, and a new CFO, Mansi Ketani, coming in as interim CFO. So it's never a good sign when there's an abrupt change in leadership. This is likely due to disappointment from the previous management team, and there was a lot of disappointment from the previous management team. And so this abrupt change in leadership is an attempt from ChargePoint to change tactic, change strategy, change direction here. So we'll see what this means going forward, what kind of decision changes there are. There was one tiny bit of good news out of this report, which I will also touch on. So it wasn't all bad news today. So let's get into some of that news. So, along with this announcement of the change in leadership, the company updated investors with how the quarter is going so far and how things are going so far. And the new CEO saying that their core markets in North America and Europe both came under pressure late in the third quarter, with revenue falling far short of expectations. Overall macroeconomic conditions, along with fleet and commercial vehicle delivery delays, impacted anticipated deployments with government, dealership, and workplace customers. Boy, was that a lot of bad news for ChargePoint stock investors. In other words, saying there was a sudden decrease in demand, a sudden change in market conditions that made its performance worse than expected. And it's already been bad for ChargePoint. The company has been losing a bunch of money on the bottom line. I'll show you precisely how much money they've been losing on the bottom line in just a little bit here. So their first step is to take an additional non-cash inventory impairment charge related to the transition and to better align inventory with current demand. Remember in my previous video I did with ChargePoint and I highlighted the inventory problem? Let me show you that here. So in ChargePoint's latest investor update where they presented their financial statements, I highlighted this inventory issue from ChargePoint. Look at the inventory balance on July 31st, 2023. 143.58 million in inventories. Look how much of an increase that was from January 31st, 2023 of 68.7 million. So inventory more than doubled in just a little over 6 months. That was concerning to me, especially because in this statement that I have here, the company said that they're taking an inventory charge of roughly $28 million. So they already said a few months ago that their inventory is troubled, meaning that they have inventory that they're not able to sell at the prices that they thought they were going to be able to sell at. And so that's an issue that arose already in this financial statement where they said they have 143 million. So I said taking a 28 million write down may not have been enough. There may be more inventory write downs coming, and lo and behold, in the announcement today, there was a further inventory write down, and I wouldn't be surprised if there is more inventory write downs coming because they're just having difficulty selling these products, selling these things that people are now less interested in buying. I know electric vehicle and the EV industry is surrounded by a lot of hype and enthusiasm, and that's been down a little bit since 2020 and 2021. There was way too much hype and enthusiasm around the industry back then. I was warning investors about getting too optimistic about this industry, but people were still flooding into these EV related stocks, and ChargePoint was one of them. The company has yet to prove it can sustain itself, ChargePoint especially. I mentioned earlier, I will highlight how much money they're losing on the bottom line. So in the 3 months ended July 31st, ChargePoint's loss from operations was $123 million in loss from operations on total revenue of $150 million. So they generated $150 million in revenue and they lost from operations $123 million. Almost dollar for dollar, they're losing money on the bottom line with the revenue that they're generating. So it's clear they're charging way too little for the products that they're selling compared to what it's costing them to produce these products and services. And even still, they're having difficulty selling these products, even though they're pricing them so low that they're losing so much money on the bottom line. I've highlighted this several times as an issue for investing in ChargePoint stock. The business is not sustainable at its current pricing structure, and there is no telling if it ever will be sustainable, if they can ever get to a point where they reduce the costs enough and increase the price enough or increase scale enough to where it can be profitable. I know there's been a lot of hype around the electric vehicle industry, but remember, it's still a small part of total car sales worldwide. It's still a small part of total cars on the road. You look at the worldwide number of battery electric vehicles in use from 2016 to 2022. While some investors might get excited about the growth, you see 1.2 million in 2016 up to 18 million in 2022. In absolute terms, 18 million vehicles on the road, electric vehicles, is not that much compared to the overall number of vehicles in the road. Annually, over 60 million cars are sold every year. Over 60 million cars are sold every year. And so imagine how many cars there are on the road, and just 18 million of them are battery electric. And so governments are trying to encourage this industry by offering thousands and thousands of dollars of incentives, and still consumers are hesitant before getting into these because they're really trying to push it faster than the technology is ready for it. The technology is not ready for mass adoption just yet. The prices are not there. The infrastructure, the supply chain, everything that's necessary to really build out and scale this industry is not there yet. So the government is trying to support it, trying to push it along faster, but it really needs to grow at its own pace, right? You can't force this issue. It needs to grow at its own pace. Along with the news that came out this morning, the company restated its forecast for the upcoming quarter, saying that revenue is likely to be between 108 million and 113 million. That was down significantly from the forecast it previously gave of revenue between 150 and 165 million. So roughly 50 million less in revenue the company is now expecting for the current quarter, or roughly one third less than it was expecting. That's a big decrease that the company is announcing. In addition to that, they're taking a 42 million non-cash impairment charge on that inventory that we talked about earlier. And they're also saying that their gross margin is going to be worse than expected. It's going to be negative 22% at the midpoint compared to negative 18% they were expecting. So it's going to still be negative, but more negative. And this is even on a non-GAAP basis. So if you look at it on a GAAP basis, it's even worse than what they're talking about here. So with this company, cash and liquidity is always a concern because they're losing so much money on the bottom line. You're always worried that they're going to run out of money. Thankfully, they recently raised $232 million on an at-the-market share offering, and they now have about $400 million in cash and equivalents. So they have more time to get themselves to right the ship. They also have $150 million revolving credit facility. But at the rate that they're going, burning cash, it's only a matter of time before they need to borrow more money or sell more shares to raise more equity, which is going to dilute existing shareholders even more. However, it wasn't all bad news. Given all of these announcements, I was expecting the new CEO to come out and say, you know what? forget that target we said about positive adjusted EBITDA, but no, they didn't. They came out and they said, we remain committed to our goal of generating positive adjusted EBITDA in the fourth quarter of calendar 2024, said the new CEO. This was a surprising bit of good news coming out of ChargePoint today in an otherwise day of terrible news for ChargePoint stock investors. So to answer that question I alluded to earlier, is this big stock price drop an opportunity to jump in and buy these shares of ChargePoint stock? And I would say no, it's not an opportunity to buy ChargePoint stock. The company is going in a wrong direction, and today just showed that they're going even worse than we had initially thought, going even worse than I had initially thought. So no, this is not an opportunity to buy ChargePoint stock.